Hello, I'm Greg Hunter. Welcome to USAWatchdog.com. The guest today, John Williams, economist John Williams. He has started ShadowStats.com about 8 years ago, and he's been a consulting economist for 30 years. John, you have had some spot-on predictions. I say to people on the internet, I quote you a lot because you're one of the few sources where I can get the unmassaged government numbers, the real numbers, quote unquote, as it were. You were out just the middle of June here with another hyperinflationary report, and the window seems for hyperinflation to begin is getting closer and closer. Tell me about why that's coming down.
Well, it's due to the passage of time. I've been talking about a hyperinflation for, at least 8 years. And at that time, I was looking at the hyperinflation within the general range of the end of this decade, around 2018, 2019. Reason for that is that the federal government is bankrupt. Obviously it's not bankrupted yet, but its obligations are such that it cannot possibly meet them. So there's an unhappy ending here down the road. The way most countries end up here is they print a lot of money to meet their obligations because they can't raise taxes enough. We have a circumstance here that if you look at the annual deficit as it's reported on a generally accepted accounting principle basis, GAAP basis, you're seeing a deficit of about $5 trillion per year. This includes the year-to-year change in the unfunded liabilities for Social Security and Medicare net present value, which means that's a cash you'd have to have in hand today in order to cover.
I have to interrupt you here just for a second to give you some credit. USA Today came out a couple of weeks ago with, the real deficit's, $5 trillion a year using generally accepted accounting principles. And, I was quick to point out to many people you were months ahead of time with that assertion that the real deficit wasn't 1.2 or $3 trillion a year. The real deficit, if you account for everything like a corporation would be, is in the neighborhood of $5 trillion a year. And you were vindicated by USA Today, although you don't need to be vindicated by them. But you were totally spot on, and you were spot on to the point where it was months, not days or weeks, months ahead of USA Today. But go ahead. All right, so the account deficits are much worse than what they're saying.
Well, unfortunately, we've been seeing that $5 trillion level plus or minus for the last several years. That's not containable. It's not sustainable. If let's say someone wanted to bring that into balance, you could not raise taxes enough. You could take 100% of wages and salaries. Take all wages and salaries. You'd still be in deficit. You could cut every penny of spending by the government, except for Social Security and Medicare, you'd still be in deficit. There's no way we can get out of this without an extraordinarily sharp cutback in the social programs, and there's no political will in Washington to do that.
When you say extraordinarily sharp, what would it be to avoid hyperinflation? What would we need to cut? How much?
You have to severely overhaul the plans. I mean, it would, as people view it now, it would no longer exist. It'd be very, very severe cutbacks, so severely painful that politically it becomes impossible. And that's why back in 2004, looking at the circumstance, I was looking at a hyperinflation out towards the end of this decade. As we got into the crisis that started brewing in 2007, came to a head with the Lehman panic in 2008, all the actions taken by the federal government and the Fed accelerated the hyperinflation process. And that's brought us into the 2014 outer time limit that I'm looking at now, and have been for a couple of years. I mean, I've been talking about this for a couple of years, but it's always been looking at it in the future. Now we're in 2012. We're less than 2 years out from that, and it's a type of thing that could break at any time.
Let's talk about that, breaking it at any time. There are, according to you, at least at one point, $12 trillion assets, and update that figure for me if you will. 12 trillion in liquid U.S. dollar assets held outside of the country. And you have said before this could start a selling panic, which could spike interest rates and depreciate the currency. Is
Yep.
that what you mean by it could happen at any time?
Yes. I mean, we're well down the road towards a major dollar panic. There have been significant developments in the last couple of years. But let me just go back to the 2008 crisis for a moment, because what happened there, very simply, was that we came to the brink of a systemic collapse. Basically, the banking system collapsing. The guys in Washington weren't kidding about that. We should not have been there. I mean, a lot of reasons why we got there. And they just would, a failure of the system is just unacceptable. The Fed's primary job is to keep the banking system afloat. It's a private corporation owned by the banks. It's not a federal government operation. And although they're supposed to keep the economy on track and contain inflation, their primary function is to keep the banking system afloat. They were failing in that. And what happened at the brink of collapse in 2008 was that between the Fed and the U.S. the government, the Treasury, they created, they spent, they lent, they guaranteed whatever they had to in order to keep the system from collapsing. They kicked the can down the road. They did nothing to fundamentally improve the economy, which at that point was in a state of collapse. They held the banking system together, stabilized it a little bit, but the banking crisis continues. The banking system's not healthy today, and you can see that in the fact that you're not getting normal lending out of the banking system. It's not just credit problems with potential borrowers. It's that the banks themselves are still impaired and can't make the loans that would be very helpful to the economy if they could. So they kicked the can down the road. Now we're coming up to the can again, and they're going to have to kick it again. We're on the brink. I mean, if you look at the headlines of the last week, if Greece left the euro, the central banks were going to get together to try and prevent a collapse of the system. They're still talking about systemic collapse. That's a real risk, and we're going to see that type of event again. Shy of that, I think you're going to see the Fed easing. Another QE3, whatever you want to call it. It's not it's not really to stimulate the economy. There's very little the Fed can do to stimulate the economy, but it's to help prop the banking system. That's what it's been all along. And we're seeing signs of stress in the banking system now. You can see that with the broad money supply, which I still track. You can see the lack of normal lending by the banks. So the Fed will come in here not too far down the road to try and put more money into the banking system. They'll do it under the cover of, oh my goodness, the economy's slowing. We need to do this to stimulate the economy. It will do nothing to stimulate the economy, but it will tend to help the banks. That's what's driving the Fed's behavior here. But the key is that when they do that, that's when you're going to start to see, again, a very heavy selling of the U.S. dollar over the last year. You go back to the early part of 2011 when you saw the so-called Arab Spring, the revolutions across North Africa and the Middle East. That's a time when you normally see a flight to quality in the U.S. dollar. That didn't happen. The flight to quality at that time was to the Swiss franc and to gold. And a little past mid-year, again, 2011, you saw a circumstance where the Congress was debating extending the debt limit, and along with that, a deficit package. That was such a horrible experience for the rest of the world to watch and see that our political system would do nothing to address the long-term solvency issues. That when it came to a conclusion, you saw a dollar panic. I'll contend that process, and we're going to go through an element of that again, but that process at the time completely destroyed the global confidence in the U.S. dollar. You saw a plunge in the dollar. Again, that was particularly against the Swiss franc, against gold. The rest of the world was exiting the dollar. And then all of a sudden, people say, oh, my goodness, look at the euro, all the problems they have. And I think the euro was used as a foil there. because as the funds were directed to attack the euro, that in turn propped the dollar and stopped the panic decline. Now there's a lot of trouble with the euro, and I can't tell you exactly how it's going to end up. But key to it is Germany. The Germans have always dominated the euro. The mark was the dominant currency going into this.
Ms. Merkel said that she will not have a common bond. They will not have a euro bond in her lifetime. Her quote out yesterday, will not have a common bond. So it didn't sound good for the union.
Well, it's not. In order for the union to work, you have to somehow abrogate the sovereign issues, sovereignty of the different states.
They have to give up control of their country.
Yes,
is what you're saying.
I don't see any of them doing that. That was a basic flaw in the founding of the euro. Effectively, I mean, they melded all these currencies together, but the effect was to have an historic and long range and forever fixing of the exchange rates. Well, they established back in the 70s that fixed exchange rates didn't work because the economies vary and the currencies will tend to go up and down, and things get out of whack, which happened here. There was no adjustment mechanism, and without a fiscal union, they're not going to make the euro work. So my betting is you're going to see some dissolution of the euro, some possible dissolution. I don't know what's going to happen with the German mark, but I would watch wherever Germany ends up because that'll be the strong surviving currency. And as the resolution takes place, and I can't tell you when this is going to happen and exactly how it's going to work, but at that point in time, the global markets are going to go back and start focusing on the U.S. dollar. I believe you'll see a very heavy selling of the dollar. The markets know the dollar is no good. They're going to come back and hit us with a vengeance here, and that's what can trigger the hyperinflation. The inflation that we saw when Bernanke started his QE2. Now this is back at the end of 2010. He was looking to debase the dollar. He effectively did that. He started jawboning, and that started the sell-off in the dollar. But the weakness in the dollar spiked oil prices, which in turn spiked gasoline prices. Now, as the dollar has stabilized, and again, a lot of that has been related to what's been happening with the euro, and indeed the Fed's ended QE2. Gasoline prices came down along with oil prices. You have other factors such as political risks in the Middle East. But whatever's happening to oil prices, if the dollar declines sharply, you will see a corresponding rally in oil prices on top of whatever else is happening.
A double whammy.
So
people will be hit at the pump, they'll be hit at the grocery store, everything.
Yep. So as we see the next round of easing or whatever triggers heavy dollar selling, you'll see the oil prices rising again. You'll see, again, flight to gold, which is the ultimate hedge against the hyperinflation here.
You know, Moody's downgraded 15 of the biggest banks in North America and Europe. I mean, Goldman Sachs, J.P. Morgan, UBS, RBC, Royal Bank of Canada, Royal Bank of Scotland. They've knocked out some huge household names in those countries, and yet the mainstream media kind of blew it off as, oh, if that was already in the news, that's no big deal. Isn't that another sign that the banking system is in trouble? It's not getting better?
That sure is. And you have to keep in mind here that the media tends to put forth as happy a story as they can, the proverbial rosy scenario. That's often an offshoot of what happens with Wall Street. You have some very fine economists on Wall Street, but most of the official spokesmen have to put out a happy story. I've run into this a number of times. Some people will give you an honest picture. I mean, thank goodness you're out there because you raise the questions. But most of what you get in the way of commentary is fed into the system by Wall Street. Tends to be happy. The politicians like it happy. Nobody wants bad news. I just try to tell it like it is. I don't sell any stocks or bonds. I just sell the information that I put out. And people don't like my information; they won't buy it.
Well, I think the unvarnished truth is always appropriate. The next crash that we're coming upon, is it going to be worse than the last one or easier than the last one?
I think this is going to be a lot worse because this will push us into the early stages of the hyperinflation. The U.S. economy has not recovered. I mean, if you look at the GDP numbers, the gross domestic product, broadest measure of the economy put out by the federal government, adjusted for inflation, which is the way they publish it so that you're not seeing, supposedly you're not seeing increases due to rising prices, but due to the physical activity of the economy. According to the GDP numbers, we've seen a full recovery from what was an economic crash in 2007, 2008, and it bottomed in 2009 and has recovered since. We've actually reached levels of activity that today are above where we were, at least as they were reporting it, before the recession hit in December of 2007. That's unusual because there's no support for that in any other economic series.
What are you saying? That the government is lying about the numbers, or they're flooding the economy with money, or both?
Well, they're not giving accurate numbers. The numbers are not meaningful. It's not that they're fudging the statistics right now. That was done a long time ago with methodological changes that they made. Because in order to get an inflation-adjusted number, you have to divide your raw data by some measure of inflation. And over the decades, the government has changed its methodologies with the effect of lowering the rate of inflation that's been reported. And when you deflate the numbers with too low an inflation rate, you get too high a growth rate as a result. The reason you're not seeing this in any of the other series is
no growth in any other numbers.
I mean, there's no other series that has matched what's happening in the GDP. That's a physical impossibility. The GDP is accurate.
In other words, the country's not growing at all.
Either that, everything else is understated. And what happens here is that if you look at the series that have no relationship to inflation, such as the payroll employment, it's bounced back a little bit, but it's still well below the pre-recession high. And in fact, it's only a little bit above where it was going into the 2001 recession. If you look at housing starts, it plunged 75%. It's been bottom bouncing ever since the downturn. Consumer confidence, it plunged, and although it's been up and down, and you'll see a lot of volatility in that, the levels, although you might be up 1 month or down 1 month, the levels are levels that you never see outside of the or haven't been seen historically outside of the deepest recessions. And then if you correct for the problems with inflation, what you'll find is that the GDP, what it does is it shows a plunge in activity, and then it bottom bounces, as we're seeing with the other series that are not related to inflation. So that it's not only is it not recovering, but we're beginning to see some signs that the economy is slowing down again.
And that's when they'll start printing money.
Pardon?
And that's when they'll start printing money. That's when they'll start releasing money.
They'll at least use that as the excuse for the easing, but it has major implications for all sorts of factors. For example, the federal budget deficit, the projections on that, the estimates of Treasury funding needs, the stress tests for the banking system, all are dependent on relatively positive economic assumptions. The first two elements are based on 2 to 3% growth in the GDP. We don't have that. We're not going to see it. So what's going to happen here is that the budget deficit is going to be a lot worse than expected. The Treasury's going to have to borrow a lot more money. Who's going to buy the treasuries? Well, the Fed bought most of the treasuries last year. That's where, again, a quantitative easing 3 could become useful, particularly if there's some difficulty in having a healthy treasury auction, which I think is, again, a virtual absurdity. The rest of the world doesn't want to really load up on treasuries or the dollar at this point.
The real inflation numbers, they say it's around 2% or so, a little more than 2%, the core inflation. If inflation was done the way it was done in 1985, the Bureau of Labor Statistics, the way you recreate it, what's the true inflation number, the real inflation number?
Well, right now they've got something that's around 2%.
Yeah.
And if you look at the way it was, the methodologies were used in 1990, if those had not been changed, you'd be around 5%, a little bit above that. And if you go back to 1980, the 1980 methodologies, you'd be up around 7%.
Right now, 7% inflation.
Yeah.
So inflation has come down some, but it's still a lot higher than they say it is.
I'm sorry?
That inflation has come down some, but it's a lot higher than the official headline number.
Oh, yes, indeed it is. In
and
fact,
you're thinking that, what does hyperinflation look like? What will the beginnings of hyperinflation look like?
We're not having any kind of hyperinflation now. This is perspective. But what will happen here, my definition of hyperinflation is a relatively crude one. I mean, there are all sorts of estimates. There are so many thousands of percent or whatever. I just look at it simply that when the largest currency largest note in circulation before the hyperinflation, in this case, a $100 bill becomes worth more as toilet paper than as currency, you have a hyperinflation. The dollar becomes worthless, literally worthless.
But what does the beginnings of hyperinflation look like to the common guy?
You'll start
what
to
do
see
prices look like? What does gas, food, housing, what does that look like?
It starts with an accelerated pickup in inflation. You'll start to see it picking up, and then it'll get worse and worse, and the pace will accelerate.
Will interest rates, mortgage rates have to go up then at that point too, which will crush housing again?
Well, the reason that rates are so low right now is because of the direct action taken by the Fed.
They're suppressing rates.
Yes, they want to keep rates as low as possible. Traditionally, interest rates tend to run with inflation. Long-term rates, you used to be able to look at the inflation rate and add 3 percentage points or 3.5 percentage points to it, and that would be the long-term interest rate. We're not seeing that now. But as inflation starts to pick up, yes, the market should be forcing interest rates higher, but even there, you're not going to keep up with the hyperinflation. If you have a hyperinflation, you don't want to be in the dollar. You want to be outside the dollar.
So you think by the end of 2014, we are full bore starting to pick up some real inflation, the beginnings of hyperinflation?
Yep. I don't see any way of avoiding it. And it's, what comes out of that, there are all sorts of things that can come out of it, but it's a bad time for most everyone. This is something that's going to be largely limited to the United States, but it will tend to exacerbate the economic problems. Let me give you a little rationale behind that. If you look at Zimbabwe, which probably had the world's worst hyperinflation over a period of time, you take an original $2 note, which is their base was their base unit, and then if you tried to come up with the equivalent in $2 notes in their last iteration of the currency, that pile of the new currency to equal the old $2 note would literally reach from here to the Andromeda galaxy, light years. Not enough trees on Earth to print it. Yet their economy continued to function over a couple of years with this terrible hyperinflation. And you wonder how that could happen. Well, the reason it happened was that they had a black market in the U.S. dollar. So that if you were being paid in Zimbabwe dollars, as soon as you got those dollars, you ran to wherever you could to convert them into U.S. dollars. Then you had your store of wealth. You could use that then at your leisure to buy groceries, to pay your rent, and that's how people survived. We don't have a backup system like that in the United States, and that's so that as things begin to break here, I think you'll see particularly disruptive circumstances that will take place within let's say, the distribution system. I can't tell you how people are going to respond, how the government's going to respond, but it's a type of circumstance that could bring normal commerce to a halt. And that's why I refer to it as a hyperinflationary Great Depression.
What should the common guy do? What should the common Joe? I mean, gold and silver have been under some pretty good, downswings here. Silver's under 30, gold's under 1,600. A lot of people are thinking, well, it's over. Gold and silver is a bad play. What do you say?
That's what you have to have here is a little longer term perspective, and that's what I'm talking about here. This is a circumstance where you shouldn't be worrying about day-to-day fluctuations in an otherwise unstable and crazy market. If anyone thinks we have a free and open stock market or such, they're nuts. These are not normal, happy times. This is a time to batten down the hatches, look to preserve your wealth and assets. Primary hedge I view as physical gold. So I'd hold some gold, I'd hold some silver. It doesn't make any difference if you buy at 500 an ounce, 1,600 an ounce, 5,000 an ounce, or 10,000 an ounce. It'll be whatever level you get it at. It will be preserving the wealth, preserving the purchasing power of the dollars that you put into it. Some guy that buys gold today at 1,600, and then a hyperinflation sees a gold at 100,000, says, "Wow, look at all the money I made here," and says, "I'm going to take my profits." He hasn't made any money. What's happened is he's preserved the purchasing power of the dollars that he put into it. This is a hedge. It's a store of wealth.
What do you think the price will go dollar-wise, just in the next few years?
The upside is only limited by the downside to the dollar. And the downside to the dollar zero, you could see millions, billions, trillions of dollars for an ounce of gold in a hyperinflation. At some point, there will be a new currency, be a reorganization of the system. I can't tell you when that would happen. I'd be willing to wager, though, that we're looking at the world's reserve currency, and the dollar will lose its reserve currency status. That'll be part of the process here. Oil will get priced in something other than dollars. It will feed into the hyperinflation. The thing is not to be in dollars. Once you get through the crisis, and if you've been able to preserve your assets and to preserve their liquidity, you'll see some of the most extraordinary investment opportunities that anyone will ever see.
So if you can hold on to your capital, you'll be able to buy houses, farm ground, anything. You'll be able to buy plenty of stuff if you can hold on to your capital and not watch it get vaporized in a hyperinflation or a high inflationary environment.
Right. Well, there are other hard assets such as real estate. You mentioned that. And stocks. You have a good solid company, or even gold stocks. The problem is that you can have liquidity problems with those. They may not meet your needs over the short term as you're going through the crisis. If you have your core, the core wealth that you need, the core assets that you need to get through the crisis, what you have beyond that for the longer term will come back and will retain its value in today's dollars. So those are hedges too. Thing is that as the system gets disrupted, you're probably going to devolve into something like a barter system. And again, things can be very disruptive there. I'm out here in California, sitting on the Hayward Fault where I live. it's not that I want to live on the what's probably going to be a great earthquake zone, but I do have a store of goods that I'd have for an earthquake. Many people do for natural disasters.
Sure. Smart thing. I lived in Florida. I had a big tub of water and food and snacks. And, yes.
Yep. This is the same thing, only it's for a man-made disaster, financial disaster. You should have a store of goods to ride through maybe a couple of months of not being able to get groceries at the grocery store, having fresh water. It will that can also save your life. Use stuff that you can recycle and replace. Doesn't cost you anything. It's just an insurance policy. But it's a good idea to have something like that.
You're saying we're going to have a systemic collapse along with this hyperinflation. I mean, we kicked the can down the road. It was going to collapse, and now we're going to head for another collapse. And you think this one's even bigger and badder than the one that we staved off in 2008?
Well, what we staved off in 2008 was a precursor to what's still ahead. They didn't resolve anything. They just pushed it down the road a little bit. And there will eventually be a crisis here that will bring the system down as we know it, despite their efforts to save the banking system. It's beyond their control to resolve the issue. So it's
a done deal. We can't fix it. It's too much has gone by.
I don't see, unless you had an immediate sharp change in the political environment, and we do have an election, but I don't see any big change coming here where someone's going to say, okay, we have to get the country long-term solvent right now.
We need to cut $1 trillion a year. We're going to start cutting, and you're going to get 30% less Social Security benefits. You're going to get less Medicare. Sorry, we can't back all these pensions. The banks, sorry, we're not going to bail you out anymore. We're going to receivership. I mean, you're talking about that kind of change to stave off what's coming.
We're overspending by $5 trillion a year.
About how much?
We're overspending now by $5 trillion a year. So how do you? I mean, I just can't see it. I don't see the political will to handle that.
After this happens, there's going to be a lot of poor people. Am I wrong?
Yep. No, you're not wrong. It's not going to be a happy time. But again, with all the bad news, the good news to the extent there is that you can protect yourself. And that's where the simple hedging of your assets can help a lot.
To be forewarned is to be forearmed. John Williams, Shadowstats.com. Thank you for appearing on USAWatchdog.com.
My pleasure.